Okay, let's jump right in. Today, we're tossing a fundamentally fascinating company, Alliance Laundry Holdings, or ALH for short, into an absolute gauntlet. We're talking the ultimate valuation test. We're going to strictly apply the investment philosophies of absolute legends like Warren Buffett, Peter Lynch, and Benjamin Graham, and then pair that with a modern discounted cash flow model. Basically, we're going to figure out what this stock is actually worth. Let's get to work. Here is our roadmap for today's explainer. First, a snapshot and Buffett's moat. Then, Peter Lynch's growth lens, followed by Graham's defensive value test. After that, we'll run a discounted cash flow valuation, look at some alternative models, and finally, wrap it up with our synthesis and final verdict.
All right, part one, snapshot and Buffett's moat.
To set the stage here, Alliance Laundry Holdings is currently trading at $25.86, giving it a market cap of $5.14 billion. Now, this isn't some flashy, high-flying tech startup, okay? They are literally the world's largest commercial laundry systems manufacturer. They build heavy-duty machines for laundromats, hospitals, hotels, the whole shebang. And their Q1 2026 earnings just posted some really strong results, with net revenues jumping 10% to roughly $427 million. They also hold a commanding 40% market share in North America alone. That means they have immense pricing power in a very specialized niche. But how does it look to the Oracle of Omaha? Well, running it through Buffett's checklist reveals a pretty sharp divide between ALH's underlying business performance and its actual balance sheet. Economic moat? Easy pass. Their commercial laundry equipment is absolutely essential, and that creates incredibly sticky long-term relationships with clients. Return on equity? A staggering 185.11%. That is off the charts, so pass. Earnings consistency? Pass again. Their Q1 net income basically tripled year over year to $56.9 million. But here's the roadblock. Manageable debt? Fail. ALH is carrying a total debt load that pushes its debt-to-equity ratio to a massive 4.49. And as you might know, Buffett notoriously avoids companies that are heavily burdened by debt. He strongly prefers businesses that can fund their own growth internally. To finish out the Buffett lens, we've got to calculate his all-time favorite metric, which is owner earnings. Extracting data from their financial profile, their price-to-free cash flow ratio sits at 26.31. So, measured against that $5.14 billion market cap, we can deduce an approximate owner earnings stream of just over $195 million. Now, while that cash flow generation is definitely strong, that high multiple means Buffett would likely demand a massive price drop to establish a proper margin of safety, especially, to offset that glaring debt risk we just talked about. Moving right along to Section 2, Peter Lynch's growth lens. Looking at their Q1 guidance, management actually raised their 2026 revenue growth expectations to a steady 6 to 7%, with adjusted EBITDA growth targeted at 7 to 8%. Because their demand is largely non-discretionary, meaning it's driven mostly by just replacing old, broken machines rather than, say, explosive new market creation, ALH fits perfectly into Peter Lynch's stalwart category. These are reliable, moderately growing companies that usually offer great downside protection during economic turbulence. And honestly, ALH has historically proven they can do exactly that. So the crucial question is, how does Lynch value a stalwart? Well, he looks at the PEG ratio, which is the price-to-earnings ratio divided by the growth rate. Right now, ALH sports a PEG ratio of 1.22. Now, in Lynch's playbook, a PEG of 1.0 is considered fair value. So at 1.22, you are definitely paying a slight premium for that growth, but it's sitting right in a fairly reasonable zone. It's not exactly a screaming bargain for sure, but it is relatively fairly valued for the reliable earnings growth it delivers. However, a massive red flag pops up in Lynch's framework when we take a peek at the ownership structure. Lynch famously loved overlooked stocks where everyday retail investors could get an edge before Wall Street piled in. But AGLH is the exact opposite of that. A whopping 71% of the company is held by just one single private equity firm, BDT Capital. That's a $2.86 billion stake. With insiders holding about 6%, the available public float is incredibly tight. For Lynch, having such massive institutional concentration, especially by one single entity that could just decide to dump its position one day, is a huge reason to be cautious. All right, let's switch gears to Section 3, Graham's defensive value test. Benjamin Graham designed his checklist for one main reason: to protect the defensive investor from overpaying. And on the first 2 points, ALH passes with flying colors. At over $5 billion, it's definitely got adequate size, and its recent earnings report proves it has excellent stability. But look at those valuation multiples. Yikes. Graham demands a moderate price-to-earnings ratio below 15.
ALH is trading at a trailing PE of 34.57. Graham also wants a price-to-book ratio below 1.5. ALH's PB is an astronomical 12.10. It massively overshoots Graham's strict bargain hunting limits.
To really drive this point home, let's crunch the numbers on Graham's famous intrinsic value formula. That's the square root of 22.5 times earnings per share times book value per share. So, with a trailing EPS of 75 cents and an implied book value of around $2.14, the formula spits out an intrinsic fair value of exactly $6, just $6 per share. Compared to the current stock price of $25.86, we are looking at a starkly negative margin of safety here. By Graham's ultra-conservative standards, this stock is severely overvalued and would be a hard, immediate pass.
Now for Section 4, Discounted Cash Flow Valuation.
Since Graham's old-school formula often aggressively penalizes modern, high-return businesses, a DCF model is really the gold standard for analysts today to figure out true intrinsic value. Here are the 3 steps we're taking. First, we forecast the company's future free cash flows. Second, we calculate a terminal value, which is essentially what the company is worth into perpetuity. And third, we discount all that future cash back to today's dollars using a specific interest rate. Because we have to fill in a few blanks that weren't explicitly handed to us in the latest earnings report, we're making some very standard, safe assumptions here. We are starting with that $195 million free cash flow proxy we found earlier. We'll project a 6% growth rate, which directly aligns with management's own long-term revenue guidance. For our discount rate, that's the weighted average cost of capital, or WACC, we're assuming 9%, which is super typical for a mature industrial manufacturer. And finally, we'll use a 2.5% terminal growth rate, essentially just keeping pace with long-term global inflation expectations.
So, what happens when we plug all of that in? Well, as this sensitivity table highlights, under our base case of a 9% WACC and a 2.5% terminal growth, the DCF spits out a fair value of roughly $21.40 per share. With the stock currently trading around $25.86, our standard DCF is telling us that the market has priced this stock at a slight premium to its actual intrinsic value.
Let's validate that in Section 5, Alternative Valuation Models.
Just to make sure our DCF model isn't operating in a complete vacuum, let's cross-reference those findings with a few alternative valuation metrics straight from the market's current pricing. When doing comparable analysis, analysts absolutely love enterprise value to EBITDA. ALH is trading at a multiple of 16.57x. Furthermore, looking ahead, its forward PE is roughly 20. Both of these metrics basically confirm exactly what the DCF just told us. Investors are willingly, happily paying a premium for ALH right now. Why? Because the market deeply values predictable, non-discretionary revenue streams. People have to wash their clothes, no matter what the broader economy is doing, and the market prices that kind of certainty at a premium. But here's where it gets really interesting. In stark contrast to our conservative, guru-based models, the 8 Wall Street analysts who actively cover this stock are incredibly bullish. Their consensus average price target is $31.38. That implies they are seeing a solid 21% upside from current levels. That optimism is largely being driven by the company's recent earnings beat, some solid margin expansion, and a recent credit rating upgrade from Moody's that acknowledges their efforts to pay down that massive debt.
Which brings us to Section 6, Synthesis and Final Verdict. Let's make sense of all this.
Bringing it all together into one cohesive picture, Ben Graham is screaming sell, seeing absolutely zero margin of safety for a defensive investor. Warren Buffett and Peter Lynch both suggest a hold at best. I mean, they'd love the 18.5% ROE and that dominant market share, but Buffett would hate the high debt leverage, and Lynch would be totally spooked by BDT Capital hoarding 71% of the shares. Our base DCF model suggests it's slightly overvalued, pointing to a hold or a sell. Meanwhile, Wall Street stands completely alone as the aggressive buy voice in the room.
So here is the final verdict. Alliance Laundry Holdings is, without a doubt, a fundamentally phenomenal business. They have an ironclad moat, a staggering 185% return on equity, and incredible pricing power in a really resilient niche. But right now, at nearly $26 a share, the stock is basically priced for absolute perfection. That heavy $1.17 billion net debt load significantly limits your margin of safety, especially if macroeconomic conditions suddenly worsen or interest rates spike again. Based on the Guru Gauntlet we just ran, you have a really crucial question to ask yourself. If the stock dipped down to around that $21 DCF fair value level, it might start looking pretty attractive to the growth at a reasonable price crowd. But at today's prices, you have to decide.
Are you willing to pay a premium right now for market dominance and Wall Street's optimistic growth narrative? Or are you waiting patiently on the sidelines for a true, guru-approved margin of safety?